You ever wondered that a bank might deny you a loan for a house or a car or even just a credit card? That's probably because no one ever sat you down and talked to you about your credit score and what you need to do to make sure that you get it as high as possible. Let's change that. Look, I understand you're busy and I know you want an answer to the question. Here it is. If you want to get a fantastic or even perfect credit score, you need to do 6 things. First is actually get some credit, and having multiple credit cards is a plus. Second is get more than one kind of credit, like a mortgage or a car payment. Third is use the credit you have available to you, but don't use 100%. Of the amount that you're allowed to use, try to use less than 10% of that. Fourth, try not to have too much debt in the first place. Fifth, pay your bills on time, every time. And number 6, avoid opening up a lot of credit cards and taking out a lot of loans all at the same time. Doing all these things, also known as being generally responsible with your money, for a long enough period should get you into good, great, and even excellent credit territory. Now, as far as getting a perfect credit score, that might be possible, but how we do that exactly is not actually known. Credit scores and how they're calculated are not public knowledge. So it's better to shoot for excellent credit, which is a score above 800, as that'll likely maximize your chances of getting loan approval, get you the best interest rates, and tells creditors you're doing everything you're supposed to do with your money, which will maximize your chances of getting a perfect credit score as well. For more detailed info and the data behind all this, keep watching. And remember, I'm not a financial advisor and this is not financial advice. The best person to speak to is a financial advisor who knows your exact situation, not some stranger on YouTube. A credit score is a number that ranges from 350 to 850. This is seen as a measure of how likely you are to pay back your loans. So banks use this number in combination with your other financial information to first determine if they even want to give you a loan. And once they determine that they do want to give you a loan, they use it to determine your interest rate, or how much money they'll make from you borrowing their money. The higher score, the lower your interest rate, which means that the lower monthly payment you have on that loan. Since most of us borrow money for large purchases, we all want to maximize our credit score and maybe even get them perfect, so that way we pay less on our loans. Maybe get a perfect credit score? What do I mean maybe? If we do everything right, shouldn't we be rewarded for that? Well, that's because unlike a 4.0 GPA, which you get by getting perfect grades on your report card, pretty straightforward, a credit score is calculated behind closed doors. And you don't just have one. The 3 credit bureaus, known as Equifax, Experian, and TransUnion, all give you a separate score. And the exact method that all 3 of them use is not public knowledge. Obviously, that sounds weird, I know. I haven't been able to find a good answer as to why this is exactly the case, but if you have the answer or you have your theories, let me know in the comment section down below. But we're not totally in the dark. They do give us 5 categories that they use to calculate our scores. So we, as regular people, can use this data to maximize our credit score. Before we get into that, I want to make one thing very clear. A perfect credit score is something to reach for, but is not necessary. Having a credit score from 800 to 850 is considered excellent credit, which means that you have the highest chances of getting any credit card you want, as well as getting approved for almost any loan you want. In addition, you're probably going to get the best interest rates available. So don't be discouraged if you're doing everything right and don't have an 850. The average credit score for people who fall in this category is 826. So a perfect credit score is very difficult to achieve. More from this graph later. All right, so what are the 5 criteria that go into a credit score? First is your payment history, which counts for 35% of your score. As far as payment history is concerned, this is your track record of making payments on time. If you miss a loan payment, you'll have a lower score, and if you make all your payments on your loans on time, you'll probably have a higher score. I understand that not everyone is perfect, and you might have missed a payment in the past. The thing you need to know if you're in this position is that that missed payment will stay on your score for 7 years. A significant amount of time, yes, but it is not permanent, so make sure you're maintaining good payment habits. And a missed payment isn't what most people think it means. Let's say Tiny Raj has a balance of $1,000 on a credit card, and Tiny Raj doesn't have $1,000 to pay off the balance in full. If Tiny Raj makes the minimum payment, this won't count as a missed payment. However, the remaining balance will start to accrue interest and will affect your credit score, which brings us to our second criteria. Second is the amounts you owe, which counts for 30% of your score. When it comes to the amounts you owe, generally speaking, the less you owe, the higher your credit score. Now, there's also another concept we need to talk about called your credit utilization ratio. This is the amount you owe compared to how much you can actually spend on your credit card. Let's say Tiny Raj has a credit card with a maximum credit limit of $1,000. If Tiny Raj spends $1,000 on the card, he's using 100% of his credit and would have a credit utilization ratio of 100%. When it comes to calculating your credit score, higher credit scores are usually associated with lower credit utilization ratios. And depending on who you talk to, it's ideal to have a credit utilization ratio of around 10 to 30%. Keeping your credit utilization low, and lowering the amounts you owe in general has a positive impact on your score. Now let's clear something up because not everyone knows this. Let's say you spend $1,000 on a credit card and you pay off that $1,000 the same day. When your credit card bill comes due, it'll show as a zero balance. Some credit formulas calculate this as you not actually using the card, which lowers your credit score. Now, if you're using a credit card that offers reward points, you'll still get the points for it, but the problem is that now you're not using your credit. At least it's not being reported that way. So one strategy you can try is hold a very small balance and let a statement generate. Then pay off that balance before the interest starts accruing, and then see if that affects your credit score positively or negatively. Third is the length of your credit history, which counts for 15% of your score. The amount of time you've had access to credit is considered your length of credit history. The longer you've had your credit card or loan, assuming you've been paying back on time, the higher your credit score generally is going to be. We need to be very careful here because I see a common mistake that a lot of people make. It's closing old credit cards that they don't use anymore. Let's say Tiny Raj opened up his first credit card at 18 years old. 5 years later, Tiny Raj opened up his second credit card, and another 5 years later, Tiny Raj opened up his third card. Tiny Raj doesn't want to manage 3 cards because he only uses 2 of them for the majority of his spending, so he decides to cancel the first card he opened at 18 years old. Canceling that first card is likely to bring down Tiny Raj's credit score because it's the oldest credit card and has the longest credit history. The concept we need to discuss is called average age of credit. In our previous example, Tiny Raj had 3 credit cards. One line of credit is 10 years old, one line of credit is 5 years old, and one line of credit is 0 years old. If all 3 cards are open, Tiny Raj's average age of credit for those 3 cards is 5 years. But closing the first credit card reduces Tiny Raj's average age of credit and makes his average age of credit 2.5 years. This is the same reason why you might find that after you pay off a loan, your credit score drops a little bit. Fourth is new credit you apply for, which counts for 10% of your score. When you apply for new credit, your score goes down just a little bit. I know this doesn't seem fair. It seems like you're being punished for accessing money, but this is a minor drop in score and is supposed to act as a deterrent for people trying to get a ton of credit quickly. From a money lender's perspective, individuals who are trying to get a ton of credit in a hurry are usually seen as higher risk. This behavior affects your score, so don't let it discourage you from opening up a new line of credit or get a new credit card. Just make sure you're doing it responsibly and in a thoughtful manner. Slow and steady is the way to go. Fifth and finally is the types of credit you use, which counts for 10% of your score. There are different types of loan and credit a borrower has access to. Creditors like to see that you can manage different loans at once, like car payments, mortgage payments, student loans, and credit cards. It's probably not worth it to go out and get a new loan just to increase your credit score because this only accounts for 10% of your overall score, and opening up new loans would affect your credit score from different categories, but having a credit mix is something good to just keep in the back of your mind. So after hearing all this, you're probably wondering, why do we accept the credit score system the way it is? It's not perfect and it's not transparent. It's because this is the best system our society's come up with. Credit scores for individual consumers from FICO have only been around from 1989, which means that for most of us watching, our parents are older than credit scores. So back in the day, like the 1980s, in order to get a loan, it was based on your character. And I use quotations because that could literally mean anything. The process of getting access to money was very arbitrary. It was subject to human error and, quite honestly, maybe unfair. I mean, imagine being denied a loan because someone didn't like the shoes you wore or something else. So today we have this relatively new, not entirely transparent system. And of course, there isn't a lot of data out there to help us get better scores. Because most people aren't talking about credit scores in the streets, we choose to do that on YouTube instead. But based on this article from the FICO blog and Andrew Jennings, we do actually have some data. It's data on people with excellent credit and what they're doing. The first key finding from their information was that generally the older the person, the higher the credit score. This is likely due to the fact that the length of credit history affects credit score, and that's probably directly correlated. But for us younger borrowers, don't get discouraged. The youngest 15% in the highest credit score categories also had shorter credit histories. The second key finding has to do with the fact that when you open up new credit, your credit score takes a few hits. The data says that high credit score individuals do in fact open up new lines of credit. And on average, the last time that happened was about 12 months ago. So not exactly often, but not exactly never either. The third key finding is that 95% of people who have an 800 to 850 credit score have no delinquencies on their account. So the overwhelming majority of people who have the highest credit scores pay on time every time. The fourth finding is that people with excellent credit scores have a lower credit utilization ratio, and they have more revolving accounts open, or accounts that you have access to credit to even if you've already paid off the balance, like a credit card. So based on the data, the best things a young borrower can do to maximize their credit score is to have multiple lines of revolving credit like credit cards, pay off their bills on time every time, don't use too much of your available credit at once, and do all of this for at least 8 years, and generally speaking, be responsible with money. Hopefully you learned something that was valuable to you, and if you did, click that like button, subscribe for more content, and I'll see you in the next video. Take care.